The Reserve Bank says starting from May last year, when the US Fed initially announced the possibility of starting tapering, emerging markets had experienced significant capital outflows. This as investors moved out of perceived risky assets and put their money in US Treasuries and other safer assets. On a year-to-date basis, it found that non-resident bond outflows from South Africa were around 28 billion rand. That's double the outflow compared to the previous year, while equities were in the positive at 16.6 billion rand year-to-date. Going forward, it says that any impact on emerging markets of a possible increase in US interest rates will depend on the manner in which it's done, but expects continued short-term volatility nonetheless. On the consumer front, the picture appears more positive, although concerns remain. Debt to disposable income is down at 74.3% compared to the first quarter of 2009, where it was at 83%. It found that consumers were taking less unsecured loans, while impaired advances were on the decline. However, the bank remains concerned about the higher cost of living, labour unrest and high unemployment levels. It argues that these factors could see some consumers defaulting on their debt, thereby creating risk for the financial sector. The bank says the financial system remains well capitalised and now complies with Basel III requirements. Nompumelelo Siziba, SABC News, Johannesburg.